When grain prices rise, governments notice. When silver floods a market, prices change across an entire continent. When a new fuel powers industry, the states that produce it gain new advantages. Commodities have shaped political power throughout history, not through abstract theory, through very practical mechanisms: revenue, trade routes, taxation, merchant networks. The states that controlled key commodities could fund armies, build administrations, and project authority across long distances. Those that lost commodity advantage often found their fiscal foundations quietly eroding beneath them. This is not a modern story. It runs from ancient grain supplies in Rome, through Spanish-American silver, through Dutch spice networks, through British coal, and beyond. Each era had its defining commodity, and each commodity in its time reshaped the balance of power. So here is the question worth holding throughout this video. How exactly did commodity control translate into political authority, and what happened when that control shifted? In the ancient world, grain was everything. Cities could not survive without reliable food. Armies could not march without being fed. Administrations could not function without paying officials. Grain was not just sustenance. It was the foundation of organized political life. Whoever controlled the grain supply held a structural advantage, not always a dramatic one, but a persistent one. In ancient Rome, grain from Sicily, Sardinia, and later Egypt was not simply food, it was a political instrument. The Roman state organized fleets to bring grain to the capital. It managed distribution through an administrative system known as the annona. It subsidized bread for large portions of the urban population. Keeping this system running required revenue. Revenue required taxation. Taxation required controlling productive provinces. The entire structure existed to ensure grain kept flowing toward Rome. When that flow was disrupted by poor harvests or threats to shipping lanes, instability followed. Not always from armies, often just from a weakening of the material foundation that held authority together. Precious metals worked in similar ways. Gold and silver were not merely wealth. They were the raw material of state capacity. Coinage allowed rulers to pay soldiers, reward officials, and conduct long-distance commerce. Controlling mines or key trade routes gave states a fiscal advantage that was genuinely hard to replace. The Athenian silver mines at Laurion in the 5th century BC helped fund the Athenian fleet. That fleet sustained Athenian influence across the Aegean for decades. One resource, one set of mines, and it quietly underpinned an entire political and military structure. In ancient Egypt and Mesopotamia, control of irrigation was itself a form of resource authority. The administration that allocated water to farmland held power that reached into the daily economic life of ordinary people. These early examples point toward a pattern. Essential commodities, those that could not easily be substituted and required organized infrastructure to produce and distribute, created durable political leverage. The key was never just owning the resource. It was building reliable institutions around it. In 1545, Spanish explorers discovered one of the richest silver deposits ever found at Potosi in what is today Bolivia. The mountain produced staggering quantities of silver across the following century and a half. Spain already had valuable trade networks, but Potosi changed the scale entirely. Spanish silver crossed the Atlantic in organized fleets. The crown collected a tax on all silver production, known as the Royal Fifth. This revenue funded military campaigns across Europe, sustained the Habsburg imperial administration, and financed colonial governance in the Americas. For several decades, Spain held a commodity advantage no European rival could match. Silver was the currency of European commerce. Controlling its supply meant shaping European fiscal and commercial life, but a structural problem was building beneath the surface. As silver flooded European markets, prices rose steadily. Historians call this the price revolution. The purchasing power of silver gradually declined as supply grew. Spain was producing more and more silver, but each unit bought less and less. Revenue looked large in raw numbers. In real terms, it was eroding. Spanish institutions did not adapt quickly. Crown debts grew. The silver revenues went largely toward wars and territorial maintenance, rather than toward building productive domestic industries. The merchant and manufacturing capacity that could have sustained long-term prosperity did not develop at the same pace. By the early 17th century, the fiscal advantages of Potosi were fading. Other European states, the Dutch and the English in particular, were building different kinds of institutional strength. The commodity advantage had been real. But without the right institutional framework, it was not self-sustaining. In the 17th century, the Dutch Republic built one of the most deliberate commodity control systems in history. Spices, pepper, nutmeg, cloves, mace were extremely valuable in European markets. They were used for preserving food, preparing medicines, and supplying luxury tables. There were no convenient substitutes, and they could only be grown in specific tropical regions. The Dutch East India Company, known as the VOC, was established in 1602. It was more than a trading firm. It was a state-chartered institution with authority to negotiate treaties, maintain military forces, and control access to key producing regions. The Dutch state had effectively outsourced commodity governance to a specialized commercial institution. The VOC focused especially on the Banda Islands, the only natural source of nutmeg and mace on Earth at the time. By establishing direct administrative control over those islands, the company controlled the entire global supply. This was commodity leverage at a remarkably precise institutional level. Spice monopoly revenues funded Dutch state capacity during decades of intense European commercial competition. The combination of naval protection, administrative control, and commercial organization turned a geographic resource advantage into a durable fiscal and political one. But the system had limits. As decades passed, spice production gradually spread to other regions. Alternative goods entered European markets. The VOC's monopoly advantages slowly eroded. Revenues declined. The institutions around the spice trade, once so powerful, had to find new foundations. The Dutch story is instructive. The commodity advantage was real and significant. The institutional design around it was sophisticated. But commodity advantages, it turned out, were rarely permanent. By the 18th century, Britain sat atop enormous coal reserves. More importantly, it had developed the institutional, engineering, and financial systems needed to mine coal at scale and put it to productive use. Coal-powered steam engines. Steam engines transformed textile production, iron manufacturing, and eventually transportation. This was not just a technological shift. It was a structural change in productive capacity that took decades to unfold. The fiscal connection ran directly from coal through industry to the state. Industrial production created taxable wealth. That wealth funded growing state revenues. State revenues supported administrative expansion, military investment, and infrastructure. The feedback loop reinforced itself across generations. British coal was different from Spanish silver in one important respect. It was not extracted from colonial territories. It was a domestic resource, and the institutions around it, property rights in coal-bearing land, canal networks, and later railways for transport, legal frameworks for investment and contract, shaped how the resource advantage translated into wider economic and political capacity. These institutional arrangements mattered enormously. Coal existed in other parts of Europe. But Britain's particular combination of geological endowment, property rights, financial markets, and market access created an advantage that lasted for over a century. When new energy sources eventually emerged and industrial leadership diffused to other states, the balance of productive and fiscal capacity shifted again, quietly but significantly, as it always had. Looking across these examples, several structural patterns emerge. They are worth naming clearly because they appear across very different periods and settings. The first is revenue dependence. States that built fiscal systems around a single commodity created a structural vulnerability alongside their structural advantage. When that commodity's price fell, when supply disrupted, or when alternatives became available, the revenue base weakened. Spain and its silver dependence, the Dutch and their spice revenues both illustrate how deeply a state's capacity could become tied to a specific commodity stream. The advantage was real, but so was the fragility. The second pattern is trade route control. Commodities only have value if they move. Whoever managed the routes, the straits, the ports, the shipping lanes, could extract rents from that movement over and above the commodity's production value. Geographic and institutional position along a trade route was itself a resource. Venice understood this. So did the Portuguese in managing Indian Ocean access. So did the VOC in controlling key island passages. Price shocks formed a third recurring feature. When commodity supply shifted suddenly, prices moved across wide areas. These movements affected state revenues, debt dynamics, and the relative fiscal strength of competing states. The price revolution from Spanish silver is the most dramatic example. But smaller price shocks from grain failures, silver discoveries, or spice route disruptions had similar structural effects on a regional scale. Merchant networks were a fourth consistent element. The commercial institutions built around commodity trade, trading companies, merchant guilds, banking houses, developed their own political influence over time. They financed state debts. They lobbied for protective policies. They shaped the institutional environments in which trade operated. The line between commercial power and political authority was often genuinely blurry. Finally, there was the recurring challenge of structural adjustment. When commodity advantages eroded, states had to rebuild fiscal foundations on new bases. Those with adaptable institutions managed the transition with relative stability. Those with rigid fiscal dependencies often experienced prolonged strain before finding new equilibria. None of these patterns operated mechanically. Each case involved specific decisions, contingent circumstances, and particular institutional contexts. But the underlying structural logic appeared repeatedly, across centuries and across very different commodity types. Quiet echoes. These patterns continued in later periods, though the specific commodities changed. The global cotton trade of the 18th and 19th centuries created new commodity dependencies across multiple continents. States and trading institutions organized production systems, controlled distribution routes, and built revenue frameworks around cotton flows in ways that echoed earlier spice and silver arrangements. Cotton was less exotic than nutmeg, but its structural role in fiscal and commercial systems was equally significant. Guano, seabird fertilizer from Pacific coastal islands, became a surprisingly powerful revenue source for Peru in the mid-19th century. Peruvian state capacity expanded substantially on guano export revenues. When guano supplies began to decline and synthetic fertilizers eventually replaced it, the fiscal restructuring was difficult and prolonged. The transition from sail to steam in the 19th century elevated coal into a strategic maritime commodity. Naval vessels required coal to operate. Coaling stations around major sea lanes became logistically essential. States able to maintain access to coal supply networks along global routes held practical operational advantages. Each period produced its own defining commodities and its own institutional arrangements around them. The goods changed. The underlying structural relationship, that controlling essential, scarce, movable commodities created fiscal and political leverage, did not change. Later industrial expansion generated still further layers of commodity dependency. Agricultural goods, industrial metals, and raw materials for manufacturing each produced new versions of the same dynamic. The history of commodities and political power carries one consistent structural lesson. Authority has rarely come from military force alone. It has consistently grown from the ability to organize essential resources, to tax them, move them, and build reliable institutions around them. States that did this well sustained themselves across generations. Those that could not or did not found their advantages gradually slipping. When commodity advantages shifted through resource depletion, price change, new technologies, or new competitors, states with flexible institutions could adapt. Those with rigid fiscal dependencies often struggled through extended periods of strain before finding new foundations. The lesson is not really about the commodity itself. Grain, silver, spices, coal, each was significant in its time. But none was significant simply because it existed. Each became significant because states, merchants, and institutions built systems around it. They taxed it. They protected it. They organized the routes along which it moved. They financed the infrastructure that made it profitable. And when those systems eventually weakened, the commodity's power weakened with them. What shifts the balance of power is rarely the commodity itself. It is the institution built around it.